Hey there, economic thrill seekers. Welcome back to Boss Economics World, where we slice through the jargon, dice up the data, and serve you the juiciest economic truths with a side of sass. I'm your host, the Boss, here to decode the latest drama from the Federal Reserve, because, let's face it, the Fed's antics are the soap opera of the financial world, and we're all hooked. Today, we're diving into the juicy spat brewing at the Fed, where Governor Christopher Waller is throwing a tantrum, threatening to dissent if his colleagues don't cut interest rates at the July 2025 meeting. Oh, the drama. Waller's out there on Bloomberg TV, waving his rate cut flag, like a matador taunting a bull, claiming the U.S. labor market is on the edge and the private sector is not doing as hot as everyone thinks. But is Waller the hero trying to save a sinking ship, or is he just stirring the pot to audition for Fed chair in 2026? Buckle up, folks, because we're about to unpack this mess with data, logic, and a healthy dose of skepticism, boss style. Let's start with the headline act, Waller's threat to dissent. On July 18, 2025, Waller went on Bloomberg TV and said he'd vote against his Fed buddies if they decide to keep interest rates steady at the July 29, 30 meeting. Why? Because he thinks the labor market is teetering on the brink and it's time to cut to save the day. Now, dissenting at the Fed isn't exactly a daily occurrence, it's like a chef refusing to cook the restaurant's signature dish. Waller himself admitted, it's important not to dissent regularly, but he's ready to break ranks because, in his words, this is an important thing to do. To understand Waller's rebellion, let's zoom out and look at the Fed's current stance. As of July 2025, the federal funds rate is parked at 4.5%, 4.75%, a level it's held since mid-2024 after a series of aggressive hikes to tame inflation. Inflation, by the way, has cooled down, sort of. According to the Bureau of Labor Statistics, the Consumer Price Index rose by 2.4% year-over-year in June 2025, just above the Fed's 2% target but a far cry from the 9.1% peak in June 2022. So, inflation's not exactly roaring, but it's not dead either, especially with early signs of tariff-driven price hikes. Waller's argument for a rate cut hinges on the labor market, which he claims is on the edge. And he's got some data to back it up. The BLS's June 2025 employment report, released on July 3, showed private sector job growth slowed to a measly 90,000 jobs, down from an average of 150,000 per month in the first quarter. Meanwhile, public sector jobs, think government bureaucrats, added 70,000, making up nearly half of the total 160,000 jobs created. Wage growth also decelerated, with average hourly earnings rising by just 3.2% year-over-year, down from 3.8% in March. And here's the kicker, the unemployment rate ticked down to 3.7%, but only because more people dropped out of the labor force. Labor force participation fell to 62.5%, the lowest since early 2023. So, Waller's got a point, the private sector is looking a bit wobbly, and the labor market's edge might be closer than we think. But here's where the boss steps in with a raised eyebrow, is this really a crisis, or is Waller just playing the hero card to boost his Fed chair candidacy? After all, he's on the shortlist to replace Jerome Powell when his term expires in May 2026, and nothing screams leadership like a dramatic dissent, right? Let's dig deeper into Waller's labor market alarm. He's saying the private sector is not doing as well as everybody thinks, and the June jobs report seems to back him up. But is this a structural meltdown or just a temporary blip? To answer that, we need to peel back the layers of the U.S. economy like an onion, and yes, it might make us cry. First, let's talk jobs. The private sector's slowdown is real, but it's not exactly a sky is falling moment. According to the ADP National Employment Report, private sector job growth averaged 120,000 per month in the first half of 2025, down from 180,000 in 2024. But here's the catch. The slowdown is concentrated in interest rate-sensitive sectors like construction and manufacturing, which added just 10,000 and 5,000 jobs, respectively, in June. Why? Because high interest rates are choking off investment. The National Association of Home Builders reports that housing starts fell 15% year-over-year in June 2025, and the Institute for Supply Management Manufacturing Index has been below 50 for 8 straight months. So, yeah, high rates are hurting, but is this a reason to panic, or just the Fed's medicine doing its job? Second, let's talk wages. Waller's worried about decelerating wage growth, but is that really a bad thing? According to the Economic Policy Institute, real wage growth was positive at 0.8% in June 2025, meaning workers are still gaining purchasing power, albeit slowly. And here's the flip side, slower wage growth helps keep inflation in check. The Atlanta Fed's wage growth tracker shows that wage pressures are easing, especially in low-wage sectors like retail and hospitality, which is music to the Fed's ears. So, Waller's labor market on the edge might just be the Fed's mission accomplished moment, unless, of course, it tips into a full-blown recession. Third, let's talk unemployment. The unemployment rate is 3.7%, near historic lows, but Waller's worried about labor force dropouts. Fair point, labor force participation at 62.5% is dismal, especially compared to pre-COVID levels of 63.4%. But here's the boss's take: this isn't new. The U.S. labor market has been grappling with an aging population and early retirement since the pandemic. According to the Pew Research Center, 3.5 million baby boomers retired in 2024 alone, and the trend continued into 2025. So, Waller's edge might just be a demographic cliff, not a policy failure. Now, here's where the satire kicks in. Waller's acting like the U.S. economy is a damsel in distress, and he's the knight in shining armor with his rate cut sword. But let's be real, cutting rates now, when inflation is still above target and tariffs are looming, is like giving a sugar rush to a kid who's already bouncing off the walls. Sure, it might feel good for a minute, but the crash is gonna hurt. Speaking of tariffs, let's talk about the elephant in the room. Waller's all chill, saying the price hikes from tariffs are likely to be temporary, and there's no sign of rising inflation expectations. But is he just whistling past the graveyard? Let's break it down with data. First, the tariff threat. President Trump has promised to slap a 25% tariff on all imports starting August 2025, a move that could upend global trade. According to the Peterson Institute for International Economics, this would raise U.S. consumer prices by 1.5% and shave 0.8% off GDP growth in 2026. Already, early signs are showing up. BLS data for June 2025 shows goods prices rose by 0.4% month-over-month, the fastest pace in a year, driven by imported electronics and apparel. So, Waller's temporary might be wishful thinking, especially if businesses pass on costs to consumers. Second, inflation expectations. Waller says there's no sign of a spike, but is he looking at the right data? The University of Michigan's Consumer Sentiment Survey for July 2025 shows one-year inflation expectations rose to 2.9%, up from 2.6% in June. And here's the kicker: the New York Fed's survey of consumer expectations shows long-term inflation expectations ticked up to 2.7%, the highest since mid-2023. So, Waller's no sign might be more like, I'm not looking. Third, the Fed's tightrope walk. Waller's pushing for a rate cut, but several of his colleagues are waving the tariff inflation red flag. And they've got a point: cutting rates now, when inflation is still above target and tariffs are looming, could be like pouring gasoline on a smoldering fire. According to Goldman Sachs, a 25 basis point rate cut in July 2025 would boost GDP growth by 0.2% but could also push inflation up by 0.3% in 2026, especially if tariffs kick in. So, Waller's labor market rescue might just reignite the inflation beast the Fed spent 2 years slaying. Now, here's the boss's satirical spin: Waller's acting like tariffs are just a pesky mosquito, but they're more like a swarm of locusts ready to devour the economy. And his rate cut remedy? It's like handing out umbrellas in a hurricane: cute, but useless. Meanwhile, the markets are watching this Fed drama like a reality TV show, with the dollar dropping 0.3% and Treasury yields dipping after Waller's comments. Investors are betting on a steady rates July but a coin toss for a September cut, per futures data. But let's be real, Waller's rebellion might just be a preview of the chaos to come if Trump picks a Fed chair who spooks the markets in 2026. Speaking of 2026, let's talk about Waller's not-so-subtle Fed chair audition. When asked about replacing Jerome Powell, Waller played coy, saying Trump hasn't called, but he'd say yes if asked. Smooth, Waller, smooth. But then he dropped a truth bomb: the next Fed chair needs credibility with the markets, or else inflation expectations will spike and interest rates will rise. And he name-dropped Scott Bessent, Trump's Treasury Secretary, as someone who knows this. Here's where the boss gets serious: Waller's right, credibility matters. Look at history. When Paul Volcker took over as Fed chair in 1979, inflation expectations were through the roof at 10%, and he had to jack up rates to 20% to restore trust. Contrast that with Turkey in 2021, where President Erdogan's meddling in the central bank sent inflation expectations soaring to 30%, and the lira crashed 50%. According to the International Monetary Fund, central bank independence is crucial. Countries with less credible central banks see inflation 2% higher on average. So, Waller's warning isn't just posturing, it's a real risk, especially with Trump's track record of pressuring the Fed. But here's the satire: Waller's acting like he's the only credible choice, but let's be real, he's already descended twice in 2025, first on the balance sheet slowdown and now on rates. Is this credibility, or just grandstanding? And if Trump picks him, will he be a steady hand or just a yes man? The markets might trust Waller now, but if he keeps playing the rebel card, he might end up as the Fed's own drama queen. So, what does all this mean for you, the savvy investor? Whether you're a regular Joe with a 401k or a Wall Street hotshot, Waller's rebellion has big implications. Here's the boss's playbook, backed by data. Waller's rate cut talk is music to Wall Street's ears. Lower rates mean cheaper borrowing and higher stock valuations. The S&P 500 is up 15% year-to-date as of July 2025, per Bloomberg data, but it's trading at a lofty price-to-earnings ratio of 22, above the 10-year average of 18. If Waller gets his way, stocks could rally further, but beware the tariff cliff. Morgan Stanley estimates a 25% tariff could shave 10% off S&P 500 earnings in 2026. So, ride the wave, but keep your lifeboat ready. Treasury yields dipped after Waller's comments, with the 10-year yield at 3.8% as of July 18, 2025, per U.S. Treasury data. A rate cut would push yields lower, boosting bond prices, but tariffs could reignite inflation, sending yields soaring. According to J.P. Morgan, a 1% rise in inflation expectations could push 10-year yields to 4.5% by year-end. So, don't bet the farm on bonds, diversify. The dollar dropped 0.3% after Waller's comments, per Bloomberg, but it's still up 5% year-to-date thanks to high U.S. rates. A rate cut could weaken the dollar, but tariffs could strengthen it by boosting inflation. According to Citigroup, the dollar could swing 5% in either direction by year-end, depending on Fed moves and tariff outcomes. So, hedge your bets with gold, up 12% in 2025, per World Gold Council data, or other currencies. Alright, folks, let's wrap this up. Waller's rate cut rebellion is a juicy drama, but it's also a window into the U.S. economy's real struggles, private sector weakness, tariff risks, and the Fed's tightrope walk. Is Waller a hero trying to save a sinking ship, or just a drama queen auditioning for Fed chair? The data says it's a bit of both. The labor market's edge is real but not a crisis, tariffs are a ticking time bomb, and the Fed's credibility is on the line. So, is the U.S. economy sinking or just playing dead? The boss's take, it's playing dead, but the wrong move, like a premature rate cut or a tariff explosion, could turn it into a real corpse. Investors, keep your eyes peeled, your portfolios diversified, and your sense of humor intact, because with the Fed, it's always a wild ride. That's all for today, economic thrill seekers. If you loved this episode, smash that like button, subscribe, and share it with your fellow finance geeks. Until next time, this is the boss, slicing through the economic noise with data, logic, and a whole lot of sass. Peace out.